Good days. I hope everyone is doing well. Today we'll be dealing with standard costing, a very difficult topic, but it'll be simple after watching this video. Okay, first of all, what you need to know, right, is the basic principles to account for expenses or income, right? So once you know these principles, you'll be sorted. So basically, when you do variance calculation for expenses, you take the budgeted minus the actual multiplied by the price if you are calculating the usage or the volume. Then if you are calculating for the what you call the price variance, you'll use the actual quantity, right? So remember, use budgeted less actual. In terms of income, it is the other way around, right? It is actual less budgeted multiplied by the price if you're calculating the volume variance, but if you're calculating the price variance, it will be actual less budgeted times actual quantity, right? But bear in mind, this budgeted, right, is the flexed, right? It is the flexed. So when you are using this budgeted units, for example, right, you use the flexed units and not like the actual budgeted units, the flexed. I'll show you how to do that in a few steps. So once you master these principles, it will be easier for you to calculate everything. Okay, now, for example, let's say now you are calculating volume variance, right? So every time you calculate the volume variance, you take the flexed unit, right? Or usage minus the actual unit or usage. Then you multiply this by the budgeted price. This is key. You always multiply with the budgeted price. So now, let's say, for example, you are doing the price variance. So when you are doing the price variance, you take the budgeted price, right, minus the actual price multiplied by the actual unit. Therefore, this will give you the price variance, as simple as it is. However, when you're doing income, right, let's say you are calculating the variance for sales, all right? So when you're calculating the sales volume variance, right, when you're calculating the sales volume variance, you take the actual volume, right, minus the budgeted volume, right, and you multiply with the contribution or gross income, gross profit, basically gross profit. Only if you're using the direct method, you could use the contribution, but if you're using the absorption method, you have to use the gross profit, right? And remember, this is per unit, right? So yeah, this is per unit. So in order for you to understand everything, right? I prefer if we were to do an activity and I'll show you everything that I've taught you, how it can be simplified and well interpreted in a question, right? So standard costing is very difficult if the key principles are not mastered. But if you master all these principles that I've taught you, it would be easier. There's no need to cram a lot of formulas that you end up confusing yourself. You just need to know the basic principles and then you'll be ready for any question. Okay, now, for example, right? Um, okay, let's read. Couch Queens Pty Ltd manufactures an inexpensive sleeper couch and uses a standard variable costing system. So this word immediately tells you that when you're doing the sales volume variance, you're gonna multiply with contribution, right? Okay. So CQ supplies large retailers who add their respective profit margins when selling to the public. Okay. The financial manager at CQ has provided you with the following budgeted information for the year. So they have produced 100 couches. They've sold 100,000 couches. So basically, what we need to do now, we need to calculate the contribution. And when every time we're calculating the volume variance, we use the budgeted, right? Okay, so now let's do this. We take the actual unit sold, which is 80,000. We minus the budgeted sales, and then we multiply the contribution. So now your standard contribution would be your sales price, which is 950. Let's do it here, which is 950. We minus our variable costs. Okay, direct material, okay, frame uses 20 kg at 5 rand per kg. Okay, so 20 times 5 is 100. We minus the 100. Fabric 10 kg at 8 rand per kg, so it is 80. So direct wages 4 hours at 30 rand per hour, which is 120. Therefore, this gives us an amount of 650. So 650 is our contribution. Therefore, our sales volume variance would be an amount of, let's quickly do this into our calculators. This would give us an amount of 13 million. Adverse, because of it gives us a negative, so it is adverse. Okay, perfect. So now let's calculate our sales price variance. Okay, so you take the actual price, which is 1,000, minus the budgeted selling price, right? And then you multiply with the actual unit sold. And then when we compute this, it gives us an amount of 4 million. So this is favorable as it is positive. Okay. Now, this is how you calculate any income variant or actually sales variances. right? So a separate video will be made where you calculate sales mix and sales variances. But for now, I just wanted to show you how to calculate the sales volume variance and the sales price variance, right? Okay, now let's do the direct material variances. So it is not a difficult topic as it seems to be, but okay, let's dive into direct material variance. So direct material variance, let's start with the price. Okay, so obviously we have two materials, so which is the frame, which is the fabric, right? So we take the budgeted price, which is 5, we minus the actual. Okay, so the 5, we got it from here. Now the actual, they gave us the total cost, right? Okay, let's sum get the total cost, the total budgeted cost. So remember, very important is that you use the actual material purchased. You use the actual material purchased when you're doing the price variant, right? Okay. So now you take the 5 rand per kg multiplied by the 226,000 and you less the actual cost. So this will give you an amount of 226,000 adverse as it is negative. So now let's do the fabric variant, right? We take the cost per kg, which is 8. We multiply by the actual purchases of 154000. Then you minus the actual cost, right? And then it will give you an amount of 770,000, which is adverse, right? So can I quickly confirm this one, as I think I made a typo? Okay, perfect. There's no typo. Okay, now this is basically how you calculate your direct material variance price. Yeah, your direct material price variance. Okay. So now let's dive into calculating the usage. Remember, when you're doing the usage variance, you exclude the closing stock. You exclude the closing stock. So here they're telling you that they have 100,000 kgs that were at hand at the end of the year. So we have to reduce them from these two amounts, right? We have to reduce them from these two amounts. Okay. So now what we have to do, right, is we have to take our budgeted, right, our budgeted material, which is 20 kg multiplied by what we budgeted to produce, right, which is 118, right? So this is the usage that we had budgeted initially, right? And then we're going to minus with the 226,000 less the 100,000 kgs. So therefore, it would give us an amount of 216,000 multiplied by the budgeted price, which is 5. So here we're dealing with the frame. Sorry for not saying it right. And then it would give us an amount of 1 million, which is favorable. Now let's do the fabric part. So we do the same. We take the 10 kgs, we multiply it by the actual production, which is 118,000, and then we minus it with the actual usage. So actual usage excludes our closing stock. So therefore, this would be 144,000, and then this would be multiplied by the budgeted amount of 8 rand per kg. Therefore, it gives us an amount of 208,000, and therefore this amount is adverse as it is negative. So basically, this is how you calculate your material volume variance. Okay, now let's move on to the labor, which is not a difficult one. Labor is normally easy because of you just apply the information the way it is given to you. Okay, so let me choose a different color for this. Okay, so labor price variance. Okay, so we're gonna take our budgeted price, which is 30 rand per hour, right? And then labor, they give us a total cost. Okay, so let's get our total budgeted cost. So therefore, our total budgeted cost, right, will multiply with the actual hours that have been incurred during the year. Okay, and then we minus what you call the actual cost. So therefore, this gives us an amount of 132,000, which is adverse. Then labor efficiency variance, like how are the employees being efficient with the labor? Efficiency. Okay, let me do this for you. Sorry. Labor efficiency variance. Okay. So you're gonna take your budgeted hours, right? And your budgeted hours, right, would be we budgeted to use 4 hours per unit, right? So we have actually used 4,000 hours, right? So now we have to calculate our efficiency variance. So now a lot of people can find the trick, right? But all you need to keep in mind is that you have budgeted to use 4 hours and we are using the actual production volume of this. So basically it's gonna be 4 multiplied by 118,000, right? Minus our actual hours, right? Multiplied by the budgeted rate of 30 rand per hour. So therefore, this gives us an amount of 96,000, which is favorable as it is positive. Now, let's move on to the easy ones. These ones that we are doing now are the ones that you should always get full marks for in the test. Okay. So now we have done material, we have done sales, we have done labor. Now let's do fixed manufacturing cost. So here you just take the 10,000. So fixed manufacturing cost variance, right? You just take the 10 million and then you deduct the actual, which is 8 million, and it gives us an amount of 2 million. Therefore, the variance is 2 million, right? Okay, which is favorable because of we had spent less than we had initially budgeted to spend, right? Okay, so now let's do the other one. We have done the fixed manufacturing cost. Now let's do non-manufacturing cost. So non-manufacturing cost variance, as it is all fixed. You see the statement here, this word, it says fixed. So there are no variable component in that, and therefore we just do it the way it is. We take the budgeted and we minus the actual, gives us an amount of 200. So this is adverse. So we initially budgeted this amount and we spent this amount. Therefore, we had spent more than we have budgeted, right? And therefore, this is an adverse variance, which is not good for management. And basically, we have done everything of this question. So this was a quite easy question, which was straightforward. Always remember the key principles, right? So if you spend more than you have budgeted, it is adverse. If you sell less than you have budgeted, it is adverse, right? So therefore, variances are very important to calculate in any businesses, as it helps you to manage the efficiency and how effective the management is running your business, right? Okay, now I'll be dealing with challenging variances such as your mix, your yield, in another video. So I hope everyone understands this basic variances, and if you have a question, you can kindly email me.